Hello everybody and welcome to today's video. Today's video is entitled The Most Undervalued Growth Stocks. It's my usual video that I do on Friday. And I explore all of the stocks in my coverage universe and rank them based on growth metric valuation. And so I do this a little differently than most. My favorite metric is enterprise over gross profit and variations of this ratio. The reason why I focus on this metric is I believe that most of these stocks are not optimized just yet for earnings, but they are optimized for gross profit. And so it's fair to compare them on the basis of gross profit. A quick reminder, on the basis of the channel, the goal is to double monetary inflation on the channel, which I estimate at 15%. So the grand aspirational goal is to find which stock is going to be able to do as much as 30% in nominal terms, not in real terms, in nominal terms, because part of this channel is to discuss also the devaluation of the US dollar. And I focus on enterprise value over gross profit. One reason why I focus on enterprise value is because I want to penalize companies that have debt, and so market cap is not good for that. I need to use enterprise value to remove the debt and punish companies that have debt. And also important to note is that most of the companies that I have in this spreadsheet are companies that are early on in their product adoption. And in a nutshell, my style of investing is I try to get in a stock early at early signs of product adoption, and I try to get out before these products are mainstream and adopted by most people. Lastly, as we go through the video, I want to pay special attention to the enterprise value over 12-month gross profit over revenue growth. This is my variation of Peter Lynch's PEG ratio, except I apply it to growth stocks. And so here, the answer that this tries to answer is how much are you paying for each percentage point of forward revenue growth? What's the cost that you're paying up for each percentage point of forward revenue growth? That's what I'm trying to answer with this question. And of course, the lower the number, the cheaper the growth over the next 12 months. But as a last reminder, this is just 12 months out video. This is not a long-term or a best stocks in my view video. This is just right now, what is the most undervalued stock? And so let's go. The ranking this week hasn't changed much from last week. We have Lovesac, which is the cheapest stock, totally forgotten stock. I mean, wrong everything, right? Wrong industry. It's in furniture at the time of the housing depression. Yet this stock is still predicted to grow, and it's an interesting one. But I don't own it yet. Then two favorites of the channel. Number 2 is StoneCo, and number 3 is HIMS. These are two absolute favorites on the channel. I've covered them multiple times, and they are extremely cheap per my metrics on the spreadsheet. Then STEM is a stock that I don't own, but I've followed multiple times on the channel. It is very inexpensive right now. INDI is very inexpensive right now too, a semiconductor stock that focuses on providing parts to EV competitors to Tesla, which is an interesting play here. And then SOFI and Neobanks, which yet again, and through the weeks, these SOFI and Neobanks have essentially the same valuation per my spreadsheet again, over and over again. SOFI is obviously a major fintech in the US, and Neobanks is a major fintech in Latin America. Neobanks is actually much bigger in terms of consumer accounts, but SOFI is in the US, and so they have wealthier customers. So that's for the cheapest. What about the most expensive? Well, that has not changed in weeks as well. The most expensive stock in there is Nvidia. I love Nvidia, but at that price, I've been out for a while. And Shopify, I find also highly expensive. To be above a 1 in this spreadsheet is really no good. And keep in mind that I've gone out of my way to select stocks that I believe are very high growth stocks. So to really be that overvalued on the enterprise value over gross profit over revenue growth, you really have to be expensive. And Nvidia is an expensive stock. So now, let me go through each megatrend, because of course my style of investing necessitates that I find megatrends to invest in, right? To ride the adoption curve of products within a megatrend. So I'm going to go through each megatrend and tell you my thoughts about all of these stocks. So Tesla and Enphase. we've had quite a bit of change this week for Tesla and Enphase. Am I right? Yes. So Tesla has obviously traded down. Tesla is now quite expensive if you look at the stock. I have put the revenue growth at 50% because they gave a long-term guidance. But I've lowered their gross margin to 19% because gross margin is not doing as well. And now Tesla has become an expensive stock. Noteworthy to note that Tesla didn't drop nearly as much as Enphase. Enphase 2 days ago dropped insanely. And so Enphase right now is actually the cheaper buy in my view. Now, noteworthy for Enphase, so their gross margin was a little up, so I increased that. But noteworthy for Enphase is I had 50% growth on Enphase, and because of this new guidance, I'm a little lost on growth. And so maybe it's gonna be flat, maybe it's not gonna be flat, and because of that, keep in mind the year-over-year number for Enphase are still very strong because they still have very low comps. If you compare like say Q1 2022 to Q1 2023, they're still really strong growth numbers compared to those comps. They're gonna have poor comps at some point, but the analysts are still saying 43%. So I'm going with a number of analysts here. I'm being neutral. I'm saying 43%. Keep in mind, of course, if you predict this company will go at 30%, then this company would likely be just as expensive as Tesla. Now, what about STEM? STEM, small cap stock. Very cheap, very inexpensive. The question is, do you believe in their energy management software? And the STEM is an energy storage company that installs a lot of megapacks, a lot of Chinese quote-unquote versions of megapacks, a lot of stationary storage for renewables and for companies and for utility companies. That's what they do. But cheap stock, probably for a reason. And I cannot figure out the state of the competition between Tesla and STEM because Tesla does not publish much about its AutoBidder software. So it's tough to compare Athena to AutoBidder, which is why this stock, I've called it too hard for me, which is why I do not own it. But definitely a cheap one. All right, moving on to HIMS and TDOC. So as you know, I am a fan of HIMS on this channel. HIMS is a stock that keeps surprising and keeps growing. HIMS focuses on preventative healthcare, i.e. they focus on a lot of minor issues, often stigmatized issues, and they try to treat them outside of the health insurance system, which gives them true agility. And they have a lot of features of SaaS companies. It's revenue growth, it's recurring shipments of RX prescriptions, right? So they have a lot of, I think HIMS has a lot of things going on. Again, I've covered this on the channel multiple times, a preventative healthcare company for smaller issues, and their growth rate has been really strong. Now, Teladoc reported decent earnings from what I saw this week. I'm out of Teladoc. I don't own it anymore, thus I don't follow it as much. But the stock hasn't moved. It's still flat. It's still cheap at a 0.25, but I still don't find it as cheap as HIMS. In fact, HIMS would have to double to be as cheap as Teladoc. And when you look at the growth rate of HIMS, of course, the growth rate is much more appealing to me, at least. Let me move on to data warehouses and data monitoring stocks. So I own all three of these aside from Snowflake. I found that when Snowflake cut its guidance last quarter, that was just too much for me, and so I sold it. But I'm looking to get back in if the stock were to actually stop flying this high, because Snowflake keeps being so expensive. So I love Datadog. I think Datadog is the main stock in there that I've been buying. I don't think I know it's the big one that I've been buying lately. I think Datadog is cheap, although they had a jump a few days ago, which is nice. MongoDB I haven't been adding to. I find MongoDB to be a little expensive. MongoDB is a provider of a NoSQL database, so definitely going to be big in the future, but in my view a little expensive. And as you know, I also like Palantir, but unlike a lot of people on the internet, I like Palantir for their military business. I think the military business is a nice business that adds a lot of margin of safety, and they are an uncontested leader in that space, and I believe that's enough to justify an investment. Remember the US government is a great customer. So I'll move on from data warehouse and monitoring, and I'll move to cybersecurity. So as you know, I love cybersecurity in the channel. It is supposed to be. Well, we'll see when we get more earnings. Net was not a really brilliant earnings, but of course, cybersecurity is one of these traditionally safe sectors in a recession, because what people say is, yeah, companies, the last thing they cut is cybersecurity. Now, what we're seeing for any of these companies is that, yes, it's the last thing they cut, but they have longer, elongated new sales cycles. It's like, yes, they keep the product, yes, they don't keep the old product, but to sell new product, to upsell, it still takes a while and it still takes longer, and so they're still impacted by the recession. So I guess it's a narrative we need to check into. CrowdStrike in there is my favorite out of all of these three stocks. It is obviously a little more expensive than Zscaler, but I do believe in CrowdStrike more than Zscaler. I think they've proven themselves more, and I think they have less competition in endpoint security. If you look at SentinelOne, for example, I don't think they are a serious competition to CrowdStrike, at least based on the videos that I've made. Now, Zscaler is the value play in cybersecurity, in my view, definitely the value play. Great stock, great management, gets little love from the market, and I do not know why. And Net, right, which is Cloudflare, which I covered earlier today. Net is a stock who revised their guidance down, and they're down 25% because they revised the guidance down by 6%. I believe Net is still a powerhouse. They are, as they call themselves, the gateway to the internet. The way I call them is it's a VPN for websites that websites use to hide the origin server, so there is no opportunity for attacks from cyber threats, but there's also faster loading, etc. There's a bunch of privacy for your customers. There's a bunch of benefits to their network. Now Net has dropped, and even though Net was the most expensive for the longest time, we now have to get used to the fact that Net is trading in line with the other stocks in my spreadsheet. But it's still not cheap by any means. Net is a heavily followed, heavily loved stock by Wall Street, which is why it's not too cheap. Nonetheless, I still own a small position in Net, and it's a position that I've had for a long while in Net. So I haven't been adding to this stock for a while. If it drops lower, I will be interested. Let me move on to e-commerce. So e-commerce is the other mega trend, right? E-commerce is growing quite fast around the world. Now, of course, it's very established in the US, although it still has some room for growth in the US. Quite a bit of room for growth. Commercial retail is still not gone. There's still plenty of growth all over the world. And Shopify, of course, is the hyper-growth play for e-commerce in the US, because Amazon is now a behemoth, and Amazon, you're really buying a cloud company. You're not exactly buying the retail business of Amazon. So Shopify is a great company. They've enabled so many other websites, so many other success stories. Actually, if you look at Shopify, they run the websites and all the systems of Figs. They even run all of the merchandise store for Tesla. To tell you, I mean, it's a pretty powerful software. Problem is, everybody agrees with me. Everybody loves Shopify, and thus the stock is expensive. And that's why, not everybody, at least the market. C Limited and MELI are the two that I'm interested in. Right now, I prefer MELI MercadoLibre because it focuses on Latin America. I think Latin America has tremendous potential. I believe that I understand it better than Indonesia, which is why I'm more comfortable buying MercadoLibre. Additionally, the problem with C Limited is that you're not in a pure play e-commerce. C Limited has Garena. Garena is a major gaming division, and that gaming division has a video game that has lost popularity. Free Fire is the name of the video game, and it's lost popularity, especially in India, because it's been banned in India, and so they are struggling with their video game division. I wish you could buy C Limited just for the e-commerce section. Now, that would be interesting, but in their annual report, this company unfortunately is still suffering from the video game division. Okay, let me move on to payments. So payments, this is my troubled category, because both DLocal and Square I'm holding to the positions that I'm not touching anymore because they're both under attack by short sellers, and it seems like a lot of the markets begin to forget about the short sellers of DLocal, but Square has had a really bad attack from a short seller. Recently, Heidenberg Research, I believe it was. Yeah, it was a Heidenberg Research. And Square also, the growth rate of Square is low now. It used to be much higher in 2020, 2021. So I'm holding on to it. I will see. However, I'm considering getting out of Square. However, my favorite is StoneCo. StoneCo, Brazilian fintech. It's close to a duopoly in that field. Their main competitor is PagSeguro. When I have two stocks that have a similar competitive standing, I try to pick the best. I think StoneCo is the best. They have a major partnership in Brazil with what they call Big Brother Brazil, which is one of the number one shows in Brazil. And you can see how this company, in my view, is embedding itself within the culture of Brazil. And I think it's an interesting play. There's a lot of small businesses in Brazil that use these payment systems. StoneCo is a provider of a payment system very similar to Square's payment system in the US. And they have a little bit of QuickBooks, but StoneCo is still going fast and heavily undervalued. And the reason why StoneCo is so undervalued, if you don't know, by the way, is because the stock dropped tremendously way before the macro drama for idiosyncratic reasons. They had a problem with the collateral registry that they were using, and they lost multiple hundreds of millions of dollars, and so the market wrote it off. But now they've moved on from that loss. They've corrected the mistake, but the stock is still 90 to 95% down. Nobody has awoken to this former darling of Wall Street. Also noteworthy to say that both Warren Buffett and Cathie Wood own StoneCo. So how odd is that? How strange? But they both own it. So I think it's very interesting. Let me move on to my semiconductor stock. So we have AMD, Nvidia, and Indie. My favorite in there is AMD. I do like AMD quite a bit. I think AMD is maybe just a tad overvalued, but AMD and AMD of course has a tiny GPU division. I mean they do sell some GPUs to gamers, but it doesn't go beyond that. They don't have what Nvidia has, right? Nvidia is the leader of professional GPUs that are used in everything we do: AI, machine learning, ChatGPT. So that's why Nvidia is trading so expensive. AMD, however, I think has a real shot at taking some business away from Intel in the CPU business. And they also have very strong positioning with their Xilinx acquisition, which is a lot of embedded electronics, Xilinx, and they also have strong partnership with a maker of video game consoles, and they provide a lot of tech that goes into these consoles, like the Xbox. So AMD, interesting play. Indie is the riskier play in there. That is why it is so cheap. Indie is a volatile stock, but they provide technologies, including infotainment system, including radar systems for competitors of Tesla that are trying to get into the electric field. That is essentially the business of Indie. I have made a full analysis of Indie stock, and it is what's fascinating about Indie, right? Why would one be interested in Indie? Would be the growth rate. Look at that growth rate, 100% growth rate. And so the question is, can they sustain that? Many questions out there, but the margin is also very high for this company, given that it really is a young company compared to AMD or Nvidia, which are much older companies, especially AMD, right? So anyways, let me move on to AdTech. Haven't covered AdTech on the channel yet. I still need to. I wish I had more time. AdTech, the Trade Desk, ever overvalued. The Trade Desk is expensive. I've owned it for a very long time, but it is expensive. But it is best in class, but it is expensive. So that's also why I haven't covered it just yet on the channel. And then Pubmatic, which I haven't covered either, but Pubmatic is more speculative, more volatile, and they are on the sell side. They help publishers sell space. Pubmatic is a cheap stock in this space. But either way, 11% or 25%, both of those have experienced drops in their growth rate. And that's understandable because of a recession. Fewer and fewer companies are buying ads, and hopefully it will come back someday. But for now, we are in a period of despair, and we need to wait until the Fed pivots and until we get out of this recession. Let me move on to lifestyle companies. So as you may know, I have covered a few lifestyle stocks on the channel. Why am I interested in lifestyle stocks? Because I believe one revolution, one mega trend right now is the emergence of new brands. Old brands do not mean much to the millennial, the Gen Z consumer anymore, because the millennial or the Gen Z has not tuned for evening news their whole life and has not been bombarded with television advertising their whole life. And so that's why all of these brands that, I'm going to say our parents, and I'm actually not that young, I'm in my mid-30s, but I would say all of these brands that say people in their 60s, they've been built on television. They've been built on television. And now that people don't watch television, it's really tough to build a brand. Brand have inertia, of course, but that inertia is up to an extent. And I believe we're going to see major change in the brands that people are interested in buying. Celsius Holdings, an example of that. If you live in the US, you probably see that drink everywhere. It's an energy drink. Growth rate has been particularly stunning. The company right now is trading right in line with my spreadsheet. I sold Celsius at around right around Christmas because I found it was very expensive. I'm looking to get back in. I hope it gets lower, and I'm hoping to get back in. One of the biggest risks of Celsius, in my view, is that Pepsi acquires them. They have a partnership with Pepsi, and I would be worried if Pepsi acquired Celsius, because then the upside is gone. Then Lovesac. So Lovesac is the cheapest company in my spreadsheet. This company is caught in the crosshairs of real estate. The market is saying, well, there's a real estate crisis. Who's buying furniture right now? Nobody is buying furniture. But they have an interesting product. They have a modular couch, and they're the leader of bean bags. It's a lifestyle brand. And when I covered Lovesac in my video, I compare them very much to Lazy Boy. Right, that's is the way I compare them. Like the closest comparison to Lovesac, in my view, is Lazy Boy. And if you compare these two companies, you realize, in my view, Lovesac has a much brighter future. So it was an interesting company. It was a surprise. It was a surprise to find this company. I didn't think this company would be that interesting, but they're still predicting to grow for 30%. So interesting one. Then Figs, and Figs is another lifestyle brand. Figs is a company that makes scrubs, healthcare scrubs, trendy, and it's trying to make them trendy. So it's borrowing from the Lululemon playbook for yoga pants, and how now most people who buy Lululemon don't do yoga anymore. They're trying to use that playbook to do that with scrubs. They're trying to get people to wear scrubs outside of healthcare. And so growth has stalled a little bit, which on the last reports compared to the last time I covered the stock, which is why I'm a little concerned, a little worried, but it's a very, 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 very tiny position for me, so I am not worried at all because of the size of that position, right? Position sizing is everything. Let me move on now to Neobanks. There's two that I like very much. It's Nubank and it's SoFi. And there's not much for me to say about the valuation, because they're valued per my metric exactly the same at 0.2 to 0.2. Yes, on an absolute basis, Nubank is valued more. It's true, but they also grow much faster. And so when you adjust valuation to growth rate, to me, it's you're paying about the same price for the growth between these two companies. I would argue they both have stigma or overhangs, right? SoFi, the biggest issue with SoFi is the student loan drama. And, the market, Wall Street, still expects student loan to come back. And I have a thesis on that. I don't think they're coming back anytime soon. I think they're going to keep postponing the deadline for years to come. Maybe a little bit like DACA. If you're familiar with what they did with DACA and how many times they postponed DACA, This is the same thing. I think it's going to be postponed for a while, and so that's an overhang. And of course, Neobanks as the Latin America overhang right now, which is a pattern you can find in MELI, MercadoLibre, and StoneCo. I mean, Latin American stocks are the epitome of value. They're extremely cheap, and I don't get it. I mean, there's a lot of opportunity in Latin America from what I see. This is a place of the world that is growing, and where more people are having access to the internet, where more people are having access to technology. This is anyway. So I'm puzzled by seeing how cheap sometimes Brazilian companies and companies in the more stable countries of Latin America and Mexico trade. It's surprising to me. Okay, and moving on to the last one, which is platforms. So platform is a mega trend focusing on business model innovations, right? A platform is a business model innovation. Platform, also called a marketplace. Typically, you'll call it a marketplace as well. By the way, these are all two-sided, right? Two-sided marketplace with an overarching company that regulates the interactions between the sellers and the buyers on the marketplace. And my favorite in there is Etsy. Not Etsy. What am I saying? I had my cursor on it. Airbnb. Airbnb is my favorite in there. I own Airbnb. I think Airbnb is a very interesting play on so many different levels. They are going after the mom and pop business of short-term rentals. In my view, many people stay in Airbnbs for a long while. And if you look at the data, it's more than a month and more than 2 weeks. Those represent almost half of the sales on Airbnb. So Airbnb is doing a great job, and revenue growth is still expected to be 30% going forward. That gross margin is amazing, and this is something that you'll see for all platforms. They have amazing gross margin, better than SaaS, 82%, 71%, 80%, amazing gross margin on platforms. So Airbnb is one. Etsy and Fiverr, we are two companies that I'm trying to get into. I yet have to cover Etsy on the channel. I have covered Fiverr on the channel. The problem with Etsy and Fiverr right now is that their growth rate has stalled, while Airbnb is still riding that pent-up demand from 2020 and 2021. Still today, there is a lot of pent-up demand for travel, and they're benefiting greatly from that. So this was it for all of the stocks in my spreadsheet. This is about 90% of all of the stocks I cover on the channel. Maybe less, maybe 80%. Some stocks I haven't included on this spreadsheet because they do not fit this pattern of growth. They just don't fit that. For a stock to be included in this spreadsheet, it has to have somewhat predictable growth quarter after quarter, and so that's my main criteria. This was not investment advice. This is just entertainment. I hope you were entertained. Please please subscribe. It takes me a while to make this video. I really appreciate all of your subscribe. Please comment. Really appreciate all of it. Thank you and have a wonderful day.